Hello, hello, hello. Can anybody hear me? Hang on to. La, da, 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 da. Where is it? Still can't find the stupid thing. Nope, it's the same problem I had last time. All right. That's me from an earlier version. Anyway, can anybody hear me is the question. So far, nobody. Let's see. Da, 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 da. Where's the frickin' thing? Unbelievable. Oh, well. We'll have to find it somewhere. Google. Oh, somebody can hear me. Corey, thank you. All right, where am I? There was that, and then I was looking there, and I looked over there. All right, let's try the video. Show your screen. Okay, let me know when you guys can see the screen, and we will be good to go. Except for the fact I still can't find that access to the webinar text. Go to meeting. August 10th, August 10th. There's two August 10th setups. I don't want to close them because I don't know what's going to happen if I do. This thing is useless. Wow. So annoying. Let's see. Access this webinar. Go to webinar, official setup, blah, 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 blah. Where is that coming from? Is that at the bottom? All right. Screw it for this time. Just know that we have a disclosure and that it is available on the other videos. And for some reason, it's not here. And I don't know why. And I don't see it on this one. Seems like such a silly thing. Anyway, all right, enough of that. So how's everybody doing today? It's a glorious day in the markets. We have a massive bump, 2%, almost 2.5% on the NASDAQ. We're looking at 2.5 on the Russell, 1.83 on the S&P, and 1.4 on the Dow. So that's amazing. But the dollar is down 1.3%, so that's your benchmark, really. I mean, if anything's not up 1.3%, if the dollar's down 1.3%, is really pathetic. Usually, it's like a 2x effect. So the people up, you know, the Russell and the NASDAQ are both basically getting the full effect of the dollar drop. The S&P is only at 1.8, so it's not quite, and the Dow is barely, you know, dropping with the dollar. So the Dow's actually having a bad day. Gasoline having a great day, if you like that kind of thing. It's up 3.2%. Let's see what else is exciting. See, gold is not doing well, and well, gold is flat. It's a different story, right? Gold is flat, and the dollar. Oh no, sorry, the dollar's down. Gold should be up substantially. My mistake. I was thinking the other way. The VIX is dead. Look at the VIX below 20. Everything must be awesome. And it is pretty awesome, actually. I mean, our portfolios are going to be doing kick-ass, although I don't see them here. Why not? Power options. So I'm not going to do a big review. Then we did that last week, didn't we? But the long-term portfolio, and again, this is intraday, so it's not, you know, fixed in stone, but I'm sure it's some massive amount. 400%. We have never been over 400%. 400% is freaking $2.5 million. So I would say it's doing well. So silly, right? Holy cow. I know we got here's Coinbase actually not losing money. They're, you know, coming back today. We thought it was going to be taking a hit, but it's not losing money. And Moderna is a big winner, I think, if I remember correctly. If I can find it with all these stocks. Well, big winner is relative, but it was really bad, and now it's getting better. Let's see. I can't believe how cheap these stocks are still. I really can. I mean, to me, Moderna and BioNTech's, they're reformulating the COVID vaccines for the new variant. So they aren't selling very many right now. Nobody wants the old vaccines. So their sales are flattish for the quarter, but the whole world is waiting for them to reformulate and put out their already approved vaccines. It's like when the new flu shot comes out, they don't go through a whole FDA thing every time. It's like they're basically the same vaccine that's already been approved with a couple of variations. So it's crazy. I mean, these are both of these, BioNTech and Moderna. BioNTech is one that works with Pfizer. And there's Pfizer, you know, also chugging along. I mean, you know, again, this is, you know, these are basic. There's so many great stocks to buy. There really are. There's so many good things out there. So what do we talk about today? Today we talked about the CPI report, which came in. I don't know. I don't know what's wrong with people, honestly. Can you look up CPI? Does that work? Nah, it's going to be some weird thing. CPI index. That's, I don't know what that is. Anyway, so the CPI this morning. Oh, I was going to check that Jackson trade. First things first. Where did I put 830? 830 updates. Oh, I didn't link it. Bad film. So the CPI came in at 8.5. 8.5% is insane. You know, and then we're having this great reaction because inflation calmed down a tiny bit. But it's such a, you know, there's going to be variations. You really can't go by what that is. So all this is caused by that. So to me, it's a very temporary thing. And that's why when something like this happens, you kind of want to take advantage of it. And maybe adjust the short-term portfolio, which looks like what? Let's see. So we have 2.5 million in the long-term portfolio after starting with 500,000. 500,000 was our start. Now the short-term portfolio, which started with, I think 100. Nope, 2. Sorry, didn't start with 2. We had 100. The market went against us for a while, so we took 100 from the long-term portfolio and put it in the short-term portfolio, and then we bought more hedges, and then the hedges paid off, and the short-term portfolio made a fortune. So the short-term portfolio is at 1.8, and that means we're over our goal because 2.5 plus 1.8 is 4.3. Yeah, just making sure. So we're 300,000 over our goal. Now, this is really hard to do because basically $300,000 is now essentially our hedge. We could lose $300,000 and still be at our goal. So we don't want to over hedge. You know, 300,000 is a good amount. It's basically erasing the last week or so of gains. And that's another reason, by the way, it's always good to check the balances in your portfolios is to make sure that you know, like, in other words, futures, yeah, futures. Okay, here's the S&P. So if you keep a chart like this of your portfolio, or I guess daily like this is more like it. I mean, you want to do something with a little bit somewhere in between, like a 3-month chart. But what you should do is on any significant move in the portfolio, you should have a running chart where you label how much your portfolios are, the balance at here, 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 and then you're going to get a feeling for how much you're affected by market moves, and you'll also get a feeling for how much you need to hedge. So in other words, on August 1st, where we think we have support now, we were at 3.8 million, something like that. I could go look at that both. So let's say we were at 3.8 million, and now we're at 4.3 million. So we've gained $500,000 for the month so far. So what are we risking? We're risking, if we don't touch our hedges, we're risking going back to $500,000. At that point, knowing what our hedges are, we know we still have the control available to us to add more hedges if we have to. So we don't feel like any kind of emergency right now to do anything with our hedges because our hedges are fine. And again, I don't remember where we peaked out with the, I think 1.8 is about where we peaked out. I don't think we're really losing much money on the short-term portfolio because we are a little bit bullish. Okay, we're a little, not too bullish, but we're a little bullish because we have a lot of short calls that expire sooner than our long calls. Oh, I'm sorry, not these. That's, no. Oh, rah, stupid Phil. That's why we're not doing better on the short-term portfolio. We moved our short calls. I forgot about that. That's how we got more, that's how we stopped from being too bullish. So when we got worried we were being too bullish, we moved our 2023s to the 2024. So we actually, that's why we're having so little movement here, because there's not much that's going to affect us right now with all 2024s. And we're pretty, messy as it is, we're pretty well balanced. So is it still a good hedge? Yes, it's still a good hedge because our TZA short calls are the 60s, right? And the 70s. So TZA is at 30. So we have incredible amounts of room. TZA can double, and we're still inside it. So we have incredible amount of room to gain if the market goes down. And the same thing for SQQ. Our covers on SQQ are the short 70s and short 80s. So also the SQQ could double, and a double would mean a 30% drop, basically a 30% drop in the index to pay off. Now we get to a certain point, we say we don't need this coverage at all. This is too much coverage. We're going to have to at some point decide what to do with it. But we'll worry about it when the 2025s come out. But it's cheap to roll to 2025, relatively cheap to roll to 2025. And if we're still going to be protecting the long-term portfolio as it is, if we don't decide to cash it out by then the cheapest thing to do is just keep the bullish positions and protect. And also you got to realize, like in the long-term portfolio, just like the portfolios we did review this week, in the long-term portfolio, we have positions that are going to make massive amounts of money if the market goes up, even if the market just goes up a little bit. So, I mean, this is a hidden tiger here, these positions. We had a huge turnaround in the short puts, that were really hurting us a couple of weeks ago. Let's see. Well, these aren't even covered. I mean, we got an aggressive Boeing position, aggressive Alibaba position. Oh, almost back to 100. We have, BioNTech, what I was just saying, is stupidly underpriced. In fact, we have the 120s. We're already deep in the money. It's very tempting though to add more of those. We have Cheesecake Factory, looking for some excitement there. How are they doing? Yep, gonna get some excitement soon too. We have Cleveland Cliffs, who I was just talking about how I know we added US Steel. Did we add Cleveland Cliffs to another portfolio? I don't remember. But either way, we have Cleveland Cliffs that we really like. We have Coinbase, like I said, but we wimped out on those and we have a cover. Although the cover, actually, look at this. Coinbase is at our goal. Or our goal is really 100, but Coinbase is at 90. So we're already where we want to be. Oh, that's a good example though. So I mean, look at this spread. It's so we take this. This is how, when I say net, just in case nobody knows, 124,750 minus 63.6 is going to be very low net. Minus 73 is going to be a credit, 73,000. So we have an $11,850 credit. This is insane. On the 2024 35.90 spread, it's in the money. The Coinbase is at 91. This is in the money, and it's a credit of $1,150. We did aggressively sell the $100 puts because I thought it was absolutely worth more than $100. So I was like, why would I not want to sell some high puts? But we have the 35.90 spread that's in the money, and that's what, $55. So it's $55 times 20 is $110,000 spread. So as an example of how much money this freaking long-term portfolio is going to crank out, right? It's a $110,000 spread with that is currently showing an $11,850 credit. So we'll make 110 plus that, 121,850 is the profit potential if Coinbase can get to 100. If it doesn't get to 100, if it stays at 90, we only have to give back 15,000 on the puts out of the whole spread. It's insane. But you know, I mean, it reflects that people have no faith in Coinbase at all. And it's one of those stocks, you know, I keep harping on that. Only trade things you understand. Coinbase is an exchange. And they exchanges for cryptocurrency and NFTs. But they just invested. See, here's the problem. They invested a lot of money during this time on building an NFT platform. They already raised venture capital and built a cryptocurrency platform. But then as that was going along, they said, hey, we should do an NFT platform too. So they took another $1 billion or whatever it was and put it into building a NFT platform. Now, they have issues with the SEC, which is, if you ever watched that Uber thing on I don't remember what channel, whatever it is. Anyway, there's a good documentary about like Uber and what happened and how they built the company. And basically, you know, they spent the first, you know, few years of their existence fighting the governments, not governments all over the world. They were at war with taxi commissions, transportation departments, so on and so forth, about what they were doing because they were doing something different. This is something different too. These guys have to go to court all the time and have to go to the SEC and whatever, and explain what they're doing and explain why it's legal. You know, it's a long-term investment, and I didn't want to own them when they were at $250, but when they were coming down to like here at 200, they were getting, you know, they got kind of interesting. We took our first piece here, and now we've rolled into this position. This is an insane position, though. It's hard to justify not buying more because this is a platform. It's not like they don't make money. You know, other crypto exchanges, they made the mistake of having the money. They were basically getting paid in crypto and holding crypto and owning crypto, and they got killed. Coinbase doesn't do that. They're a straight up exchange. They get a fee for doing their job. But as you can see, last year they made $3.6 billion. This year and next year they plan on losing money because they're in the middle of doing stuff. They're building things. But the revenues are there. Not like last year, but the revenues are going to be there. And they'll go back to being profitable. There'll be a nice little exchange that makes a nice amount of money going forward. So, you know, it's a future sort of thing, and I don't mind holding on to them. I just think there's enough potential there that this is way too low for them to be trading. You know, it's not a value stock, but it's a stock that I think is definitely going to be around for a very long time and build over time. Let's see. Oh yeah, portfolio. Here's Dow Chemical. Why is that so cheap? I don't know. What does their chart look like? Yep. So they'll start turning up too. You know, a lot of these guys are just waiting for them to get past earnings. Here's eBay. Also, why so cheap? eBay. Gilead is a money machine. That's silly. GOW. Here's Barrick Gold. Also, why so cheap? It doesn't make any sense. You got a lot of stocks here that I really like. I guess that's the point of the portfolio. Look at this. This is crazy. So let's look at the numbers for Barrick Gold. Okay, futures first. Futures. Gold. Because what does Barrick Gold's a very simple company to analyze. What do? They sell gold. They pull it out of the ground and they sell it. Gold hasn't been this high in many, many years, right? So all these years up to 2020, Barrick Gold has been selling gold for $1,300 an ounce or $1,250 an ounce, right? So now let's take a look at their numbers. So wait, well, that's not them. Thank God I actually know these companies, because I look at the numbers, I'm like, that's wrong. I can tell right away. All right. So in 2016, and by the way, and every year they sell about 5 million ounces of gold. They don't change much. They generally sell 5 million ounces of gold a year, because that's the net of their mining operations. There's no magical way to really increase it very much. They open another mine, they close the mine. It sort of ends up being about 5 million ounces a year that they pull out of the ground. So their revenues, $8 billion, $7 billion, $9 billion, right? All of a sudden, that's when it went up, 12 billion, 12 billion. They projected to stay around this price, 12 billion, 12 billion. So profits were, for whatever reason, this was a bad year, but 1.5, minus 1.5, very bad year in 2018. And it could have been write-offs. It could have been a lot of stuff that they did. I don't actually know what it was. Then the next year it's 3.6, but what's the average? It's still 1.5. All right. Then 2020, it's up. Now it's up around 2. It's going to stay around 2. All right, $2 billion. It's a $30 billion company. So you're getting 15x for the gold, for the company with the gold. They've got reserves, 70 million ounces. Okay, so 70 million ounces times, let's say 1250. All right, let's say it falls back to 1250, which is very unlikely. That's $87 billion. They've got $87 billion worth of gold in the ground. Now, it doesn't matter how much gold you have in the ground, though. It matters how much your extraction cost is. Barrick's extraction cost is roughly $1,150. They're the lowest in the industry. That's why gold isn't likely to go back below 1250. People can't pull it out of the ground for that price. You can't pull it out of the ground for less. It's like anything. You're not going to produce it. They're not going to take their gold out of the ground and sell it for a loss. It doesn't make any sense. So if their extraction cost, and that's an all-in extraction cost, that includes how much they bought it for and how much their expenses are and so on and so forth, and the actual physical cost of pulling it out, marketing, selling, everything, that's their cost. So if gold persists at 1750, they're making about $600 an ounce times 5 million ounces is $3 billion. Okay, so they're not making that. They've got operating expenses and things, but let's, whatever it works out to. But the point is, now, if on the other hand, is a big if though, let's say that gold drops to $1,400 an ounce. They're still going to spend $1,150 to take it out of the ground, and then they're only making $250 times 5 million. It's $1.2 billion. And if they have $1 billion almost in operating expenses, they'll cut some back, of course, but then they'll only make about $250 million, $300 million. All right, you also have to look at their debt, by the way. They don't have debt. So that's also, you're catching them at a good time. Sometimes they have debt. Right now, they don't have debt. They will have debt. They're going to borrow $5 billion and buy their competitors out when gold does dip. That's what they do. You know, the way Barrick runs, I think we talked about this last week. The way Barrick runs, though, is they will buy out a weak competitor. They'll buy out a weak competitor as long as they have a gold mine that they want. They'll buy the weak competitor and take the one gold mine or two gold mines that they have that are running at Barrick's operating cost, or the Barrick engineers believe they can get into line with their operating costs, because not everybody does it the right way, of course. And then they sell off the rest. And as long as they get the mines that they want, producing at the price that they want, that's what they do. And that's why I love this company. It's a very, very logical strategy, right? Just be the lowest cost gold producer, and you're never going to lose money. You might not make a lot if gold crashes, but you're not going to lose it, and it can't stay that low for that long. If nobody else can afford to produce gold as cheaply as you, it can't stay that low for that long. And also, and a big also here, it's a massive inflation hedge, because what happens if gold goes to 2,000? If gold goes to 2,000, Barrick automatically makes $1 billion more dollars, $200 more an ounce for 5 million ounces. So their income can jump 50% just based on a very tiny amount of gold, of movement in gold. We go to 2,500 or something crazy like that, they're going to be just making money hand over fist. And then then we would decide what to do with it. But right now, I mean, it's just it's a great stock and a great inflation hedge. So it's silly not to have it, right? Hanes, are they ever going to move? Underwear people, HBI. I don't think they had earnings yet. Oh, very important thing. Yeah, HBI. All right. So what's holding people back? What's holding people back is supply chain issues. What's causing the CPI, supply chain issues, things like that, right? But look at this. This is very important because I have shipments that I'm working with. This is the Port of Los Angeles, okay? There's only 14 vessels berthed at the moment. They're spending 6.1 days. There's 98 planned containers coming in, and they have 18 this week, 21, 23. So they're getting, see how this is? Change from the previous year, up 9.8%, change from previous year, up 17%, change from previous year, minus 11. They are rapidly getting back to full capacity. Things are moving through the ports. There's only 7 vessels coming in, and if you click on them, they're actually fairly stretched out. All right, August 9th, July 29th, wait. Expected date of birth, sorry. So August 10th, 14th, 15th, 18th, 24th. So that's not really a heavy capacity. There's a bunch coming in today. They're in good shape. They're turning, they're turning their average time of waiting berth now is 6 days, wasn't it? Yeah, they're turning the ships around in 6.1 days, and they're catching up on everything. So it's not us. This is a very key thing now. We're not the bottleneck anymore. We were the bottleneck. We had 40 ships backed up in Los Angeles. Now there's nothing really backed up in Los Angeles. So it's a big, big change, and that's going to mean a lot. That means the delays are in people like China who have lockdowns and so on and so forth, and manufacturing closings and shipping deals. But that's all going to, now that our big bottleneck is worked out, everybody's bottlenecks are going to start easing off. And ships are going to start hitting the water, and as long as we don't have another setback, we'll be in much better shape in the next 2 quarters. So when you hear these companies telling you these things, there's problems, you have to think, how long is it actually going to last? So to me, when I hear an earnings report and the guy says, well, it was supply constraint this, supply constraint that, you're like, okay, well, that's getting fixed. Okay, that's not a reason to sell this company. That's in the past. Put it behind you. You got to look at also the currency issue too. I'd say the average company on the S&P 500 has got to be getting a 5% hit to their foreign exchange. I mean, just insane money on the forex, because the dollar is so strong compared to everybody else. So What are we going to do about that? That's also going to eventually fix itself. One way or another, these things kind of work out. I mean, if not, you end up repricing things to account for the fact that the dollar is stronger than our other currencies. So look at the dollar. Everybody, you know, the euro, especially Euro, Japan, England, Canada is actually holding up well compared to the dollar. And that's because they're an energy-based economy, of course. But people are taking really bad hits. The euro was testing 1. That's parity, even to the dollar. That's crazy. Anybody who travels knows that. So that's where we are now. And the dollar hasn't stopped. The dollar is just testing the 105 area to break higher. It did almost get to 110 just now. So we got, you know, we've got a really super strong currency, and that's terrible though, because especially if you're, and again, you have to think about the company that you're looking at. And if you've got a company that manufactures in the US or has service people in the US, and you sell your goods in foreign countries and you're getting paid in foreign dollars, that's a problem. And especially since this is the last 2 years, everything, whenever you price something in dollars in a foreign country, I'm sorry, whenever you price something in a foreign currency and have to convert the money that you get back to dollars, it's worse. If you sold it in March and you convert the money in June, it's worse. If you sell it in July and convert it in August, it's worse. So it's constantly been getting worse. This will stop one day and flatten out, just like this did. See here? It'll stop and flatten out and no longer be an issue that people are worried about. But right now, it's horrendous. These are some massive, massive jumps in 2022. So, you know, Coca-Cola, you've already sold it. You've already written a contract. I'm selling you Coca-Cola for I'm not trying to figure out how to most easily say this. I'm selling the Coca-Cola for €1. Okay, let's inverse this. So I'm selling you a Coca-Cola for €1, and I'm shipping it to you, and you're going to get it in a month or so, and you're going to actually sell it and turn around and pay me. Let's say it's a quarterly deal, right? So at the end of the quarter, you're going to send me the money. So here's me selling, writing the contract. Here's it getting shipped. Here's you selling it. Here's you paying me back the money. And it's gone from 1.22 to 1.17. It's gone down 5%. That's exactly what's happening to these guys. So by the time they get paid the amount of euros that they were promised, it's worth 5% less than it was when they wrote the contract. That's what's happening to these companies. So when they talk about foreign currency exchanges, things like that, you know, and car companies, same thing, right? You say you're shipping cars overseas, they're selling them for a certain price. Those cars are in transit while they're selling them, and meanwhile the money's changing. See, I remember in the 80s, I used to go to Europe, and all the restaurants would have their menus written in chalk. They wouldn't even give you a menu. The menu was written in chalk with the prices because they would change them every day. I mean, there was no way they could afford to sell you food at some fixed price. It was just killing them. So, you know, and they weren't ripping you off. They were just like, this is the price. I can't help it. Today it's this much, tomorrow it's that much, tomorrow it's that much. Especially Italy. Italy was crazy, completely crazy. Their currency was like all over the place. So that's, I guess that's kind of embedded in me from my young travels. It's just that I'm very well aware of like how badly currencies can screw up a business. And you look at these companies and you read the reports, and you got to be cognizant of like what's really happening to them. Why is this happening? Why is this going on? So Hanes, back to that, wherever they were. So Hanes is a good example of that. They make stuff here. They make cotton underwear in America with American workers for America. So they pay American dollars for their goods and services, and they ship it out overseas, and they get killed by currency exchange. When the dollar is strong, it's horrible for their business. When the shipping delays are horrible for their business. But on the bright side, they're not selling flowers. So it's not like the underwear goes rotten while it's sitting on the ships, right? It's like somebody still needs underwear somewhere. It will get sold eventually. And what a good, and again, what a good company. We have a ton of it. Where is it here? So Hanes, $4 billion market cap, 1168. They're making, and again, very, something happened here, something happened here. Basically, they make about $500 million a year. Look, 6 billion, 6.5, 6.8, 6.4, 6.1, 6.8, 6.87. This is a boring, terrible company that does nothing but make underwear and sell underwear. That's all they freaking do. They've been doing it for 50 years. They'll do it for another 50 years. It's not like people are banging down the door saying I could build a better underwear company. They make $500 million on a $4 billion valuation. That's less than 10 times earnings. It's seven times earnings according to this thing. They do have a lot of debt, $3 billion. And what you got to do is you got to take $3 billion. Our rule of thumb at the moment is that we take the $3 billion times 0.03 interest, and that's $100 million. So what's going to happen to Hanes then is they're going to lose on their earnings. It's going to go down to 450, let's say. Still 450, very acceptable with a $4 billion valuation. So definitely want to own it. Think it's way too cheap. I'm waiting for it to get to around 10x, and then I want to cover it. I don't expect exciting things. I don't expect great stuff. 10x is going to be they're at 12, so maybe around 16. So I don't think they're going to get all the way back. I don't think they'll get to 20. I think 16-ish is about right. Not even 18. 16 is probably going to be right for them. And then it's a long-term hold. But right now it's just stupidly cheap. Here's Hewlett Packard. We cover them. IBM's our trade of the year. Intel, also stupidly cheap. They just passed the CHIPS Act, though. They let it. Nobody's giving Intel any respect at all. And yes, it's a rough year for them. It's going to be a rough year. They're not going to make any money. Nothing exciting is going to happen. So, this is a next year play for sure. But again, it's a cyclical company. It always has been. They're in a low part of the cycle right now. But even at this low part of the cycle, $141 billion market cap. Also nice and boring, but with growth. All right, 59, 62, 70, 71, 77, 79, backtracking here. Okay, money 10, 9, 21. It's because they came out with different chips, but now they're in the bottom. Now they're in the bottom part of the chip cycle, and when the new chips come out, they're going to start doing this again. They have to develop. They have to spend time. They're spending $40 billion on a new factory. So, they have to develop their new chips, and they have, and it's not like new chips, like a new underwear factory for Hanes. It's new chips like now we're talking about angstroms. We're not even talking about microns anymore. We're talking about angstroms, which are 1/1000. And now we have to use atomic. I don't even know what they're doing. I mean, it's like these things, angstroms, like the measurements of an atom. And so they're like 3 atoms wide, these chips or something, these circuits like 3 atoms wide. And and they have to use, and so how do you make something like that? We have to have a 1 atom laser that pushes them into position. It's crazy. And what happens next? You got to go subatomic after that. That's why quantum, because we're really at the point where we literally are going to have to go subatomic for the next set of chips. Anyway, bottom line is it's kind of expensive. This is really cutting edge stuff, and it's very expensive, and they have to actually invent it first, then build it, then test it, then blah. It's a cycle. So it's a cyclical company. But you know what? Who the hell else is doing this other than Samsung? They on the real bleeding edge, cutting edge stuff. There's AMD and there's Intel and there's Samsung. There's not many people doing the sort of thing, and they're not going to. So that's the moat that built around the business. Then there's the people who trust them for the things. And again, it goes to the same thing. If a new chip company comes along and says they have this great, better chip, blah, 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 it doesn't mean that Dell is going to trust them to be the chip for their 2026 line, right? Right now, you'd have to sit there and look at a prototype and say, okay, I trust you to build me 5 million chips in 2026. You know, or if you're Apple, you have to trust somebody to build you, what is it a year? 150 million phones now a year, or something like that? Some crazy number. So if you're Apple, you have to say, yeah, you're gonna build me 150 million phones with this chip in 2026. And if you fail, my whole company goes down the tubes. You don't trust new companies with that kind of stuff. People have to prove themselves over long amounts of time, which means that Intel, their market share is very, very protected. They might lose it to AMD or whatever, but it's a Coke and Pepsi thing. You're going to go with one of the major guys. You're not going to risk your entire company on somebody surviving 4 more years before they can even give you the chips that you're looking at now, which are prototypes. You know, it's tough business to crack into. So I like Intel for that reason. I like him for the long term. And we are aggressively sitting on it right now, expecting it to catch on at some point. Anyway, I'm going to go over the whole thing. But just to give you an idea, there's so many really great companies here that are, and the amount of money that you can make off of these things. Here's Moderna. Let's take that. It's a good example because I want to talk about them. Moderna is actually ridiculous because what do we have here? Okay, so we've got 293,600 minus 133,088 minus 46,300 minus 29,525. So we've got $54,000 of a net in this position. And what it is, it's a 80 times 40. It's a $320,000 spread. That is $50. It's $200,000 in the money. It's almost all in the money. So this spread is $200,000 in the money. We're aggressive on the puts. And again, it goes back to the fact that I don't see how this is not a $200 company. Therefore, I'm going to sell the $200 puts. So we're aggressive on the puts. We're in the money by $200,000, and you can buy the spread for $554,000, and it'll cap out at 320, or not counting the 5 open that are here. We even left room to sell some short calls, but I'm not going to sell short calls at this price. It's still too stupid. Look at that. And I mean, that doesn't make it stupid, but I mean, just the price is ridiculous, because if you look at this, if you look at the actual, what do these guys do? Like I said, why did they get stalled out here at this level? Because nobody wants a vaccine they have now. They're waiting for the next version of the vaccine. Then everybody wants that. And they're looking at this year $11 billion in revenue. Next year it trails off, but when they get the new orders for the new vaccines, they'll be back to 11 billion. This is a $66 billion company that's making $11 billion this year. And also look at this bank account. They got $7 billion in the bank. Crazy. So don't say there's nothing to buy. There's plenty of stuff to buy. It's like so many great bargains out there. It's incredible. So, okay, we looked at the ports, so we can close that. I don't think I need that again. Look at the portfolios. I don't even know what the other portfolios are doing. Butterfly. Butterfly is probably some psychotic number. Oh my God. Get out of here. Oh my God. Wow. I don't even know what to say about that. That's up 800%. Wow. Okay, so that's huge. Yeah, I mean, look, all we did, and honestly, you got to go back to those June things when we were making these adjustments. All we did was when the market got to a level that we had predicted it would get to, if I can find this thing, it knows it's me, dashboard, default list. No, 2022. That's the most recent one? That doesn't make sense. This is terrible, right? It doesn't date things at all. All right, let's see if that's it. All right, well, that seems to be the right one. So, you know, here was the high for the S&P. Okay, we went to a lot of cash at the time. We thought it was ridiculous. We banged up our hedges. And at the time, we said that we're miles over the strong bounce line. We expected to at least go here, but I said probably we're going to fail 4,000. We were looking at these lines as the bottom, but only to say it was the bottom, because that's what happens in a sell-off. You overshoot the mark. But the proper line, the support line that we should be at is 4,000, and that puts us in this range, the range from 4,000 to 4,400, and from 4,000 down to 3,600 is the actual range. But using the drop that we had from 46 or whatever it was, these are the lines we expected to be holding on the 5% roll using that calculation. But the range area that we're going to be in now, if you throw out these lines are based on this drop, okay, that we predicted. Then we have the bounce lines. So they're not 5, because 5% of 400 would be well, 5% is 3,200 actually. So we'll talk about that. So 2.5% is 400 is 36. So it's not exactly, it's not, we can, you know, these calculations were not made using 4,000 as a base. We made them based on the drop. Like, so I can remember it so long ago. Remember when the death cross came and I was like super warning everybody, like that death cross is a terrible signal and everything's gonna fall apart soon? That's exactly what happened. But it's not just because of the death cross. That's what you guys got to understand. It's not because there was a death cross I said, oh, it's a death cross, we're going to die. No, the death cross was just the final nail in the coffin, because the valuations were ridiculous this whole time. I objected to everything that was going on up here. If we can get the S&P to go back further. So let's say if we do gallery view, that's PX, much longer time frame, please. That's not longer, that's longer. All right, so at this point, I was getting bearish about the market, because first of all, the simplest thing for me to, you guys know, every once in a while I do a valuation study, and I'll take the top 20 stocks in the NASDAQ or the top 20 stocks in the S&P, and I'll value each one very, very carefully to say, this is what this stock is worth. So once we do that, we get a good idea of where the index should be. I did that with the NASDAQ, I did that with the S&P, and we decided that this was stupid. And also you get the feel of it, because I can't find anything to buy. If I can't find anything to buy, there must be something wrong. I'm good at finding things to buy. When I find a ton of stuff to buy, I know we're at the bottom of the market. All right, because I'm an M&A guy. I just happen to do trading now, but I'm a valuation person. And you know, when I look at a company, as to whether or not I would take my actual money, my billions of dollars, and buy this company. And if I wouldn't, then it's not a good buy. I don't give a shit. There's no reason. If I'm, you know, you can't be willing to spend $100 on a stock and not be willing to spend $2.5 billion to buy the whole company. It doesn't make any sense. If you wouldn't own the company, if you don't consider it something that you would want to buy the company and work there from now on, and that's your thing, which, you know, which people do, right? Like Buffett or whatever. If you aren't willing to actually put your foot down and say, this is my company, it's a great deal, I want to own it, then you shouldn't be buying it. Then there's no amount of money you should be putting into it if it's just a lark. So, you know, when we're up here, I'm holding a pointer for no reason. When we're up here, it makes no sense to me to physically point at the screen. So when we're up around here, there's nothing to buy. Didn't like anything. I was saying gets cash all winter long. Then the death cross happened. I forget where exactly, but oh well, wait, go up here. Then the death cross happened in March, and that was the end of it. That's when it's all over. Once that death cross came in, that's the signal to get the frick out of everything. It's right about here. So we went down, we came back a little bit, but it was too late. The technical damage was done. So even though we were coming back, the 50-day had taken too much damage and was falling. And then even though we went back above it, we didn't pull it back up. You see how you're trying to pull it back up from being above it? But it wasn't enough. And as soon as we crossed back under, it resumed its downtrend all the way down. And then that became your resistance to the upside, right? And it becomes a resistance to the upside until what? Until I can't stand not buying things. I go from I don't want to buy anything. I can't. Everything looks good. Not everything, but you know what I mean. But these are just normal market cycles, and stocks have cycles too, just like Intel. Intel is now here. So even though the S&P is recovering, now we have to start being more careful, looking for things that haven't recovered yet, even though they should have. And that's because, you know, people got burned on them, or they went out of favor, or there's rumors about the stock, like Coinbase, like there's people don't understand what they actually do, so they're freaking out. Like SoFi, I think, is not doing particularly good still. Another one people don't understand, it's getting a little bit better. And then we did a couple of top trades in the last couple of days. Oh, what was one I did today? Not today, yesterday. So yesterday we did Jackson, was another example. So, you know, now it's not like, you know, like when I was on a month ago when I was on Money Talk, I had a dozen stocks and I was like, I put my name on this dozen stocks. I had a dozen stocks, boom, like these are great stocks, buy every one of them. Now I got to look. You know, yesterday we did 3 different stocks in the top trades, and I looked at like 25. That wasn't happening to me a month ago. A month ago, I wanted 12 out of 25. Now I want 3 out of 25. So now we're getting more into the range of where things are fairly valued, because I'm not going to pay 20x for a company still if I can avoid it. We still have potential problems, and the problems didn't all go away. The war isn't over. COVID isn't over. Inflation isn't over. You know, we just got oversold. Given those factors, we got oversold for a bit, and things got cheap. There are still cheap things, but eventually we're going to buy all the cheap things. And if you want to be a smart trader, when you bought all the cheap things, stop buying. This is the problem people have. People, for some reason, think they have to buy something. You don't have to buy something. Buy something when it's cheap. Don't buy something just because you sat down today and decided to trade. Okay? Like my grandfather used to go to all these auctions, you know, to buy antiques. And he loved it, but most of the time he bought nothing. Most of the he would bid, you know, something come up, he'd raise his thing, bid on a couple of things, but it got too expensive. He'd be like, nah, forget it. You know, it's like, I'd love to have that. Here's anything he'd say to me, he'd say, all right, I hope I get that. That's great. That's definitely what I want. And then it goes to like a price, which I think, and then it goes a little bit over, and he's like, no. But that's how you buy. He was also a great investor, because for the same reason though, because he wouldn't buy anything that wasn't cheap. It's a pretty simple concept, but people don't do it. Hey, we were going to look at this one and see if it made any money. Where are we? Jackson. So now on Jackson, we've got the 30/40, right? So it's now 758 and $4. So that's 350. So it's 350 for the spread, and the short 25s are $4. So it's 7,000 minus 4,000 is $3,000 is what it currently is. So, right, because 350 times 20 is 7,000 minus 10 of the 4,000. So now it is what did I just say? 3,000. So now it's net 3,000, and the price that we came in at was actually a net credit, right? We had a $400 credit. So this thing's up from $400 credit yesterday to 3,000 today. So it's a $3,400 profit in 24 hours on this spread. That's why that's why I put it in the earnings portfolio. It's an earnings play, but now we're going to keep it because it's still a $20,000 spread, and it looks like it's going to be on track. But we made 3,000 already on day one. There's only 17,000 left to make. So, and it's funny, right? Because now we have a spread that cost us $3,000 that can make $17,000, which is still like 5 times, profit. Well, it's actually 14, whatever. That's a big difference. 4 times, well, it's 4 times profit. So I can still make a 4 times profit. But that's so I didn't need to buy naked calls to make a tremendous amount of money, right? We made $3,000 off of a $400 credit. So, almost 10 times in one day. And that's with a spread that is sensible, because had it gone bad on us, these puts were $5 out of the money. So we had a good amount of cushion there. This call spread didn't have a huge delta, so it wasn't going to lose us a ton of money. And then we would roll it and adjust it and do whatever if we had to, if it went lower. But it didn't go lower, it went straight up, and now we're making money. And this is an example of one of those trades where I say it's a lot. We take these trades and they're small. It was a very small commitment of cash. It was a very small, we intended to commit 700, it came out cheaper. It's a small commitment of cash. It's a small commitment of margin, $25,000 if we get assigned on the stock. But so in other words, we could easily double down on it if we wanted to. But it went straight up. So what are you going to do? It's like that's going to be the trade. We're not going to expand on it. We're just going to watch it, and very boringly, it's going to pay us our full $20,000. Oh, JXN. But and again, we've talked about Jackson for quite a while now. It was lower, but it just, for whatever reason in June. But now that I happened to look on the calendar and saw that earnings were coming up, and it was recovering. So it had already gotten to $28 from 25. So it had already bounced off the bottom, and I was worried this was going to happen yesterday. So I said, before this happens, we better get in there. Yeah, and notice you're getting kind of a mirror of a recovery, right? Like everything that happened before is now going the other way. And that's really because the same computers are trading it just now in the opposite direction. And if all goes well, look what lies ahead. So we have something like this could happen very easily. We can go back here, consolidate a little bit, and then boom. Because easily this thing is worth $40 easily. See if we have any questions. No questions. Must be doing something right. All right, what else? No, that's it for that. Let's see. Well, so, if you want top trades, there's a top trade button here, and that takes you, I think, to the section with top trades. So we had Jackson, and then also yesterday, Cleveland Cliffs and US Steel, and 2 other trades there. And you see how X is popping now and Cliffs is popping now. You know, and again, it goes back to, it's the same thing. I don't want it to get away. I see something and I'm like, oh, that's getting a little bit too hot, but they're on our list and we're just watching them. So here was Walgreens. Yodi's favorite stock is Walgreens. Big Lots. This is the stuff we've been doing late. Big Lots still very cheap, right? Also, we put it in the earnings portfolio. Ooh, KHC took a hit, huh? July, August. Oh no, that's a fixed chart. That's why. That's the day we bought it. Yep. See how weird I am? I see a chart like this and I go, ooh, I want that. Because they were wrong. I'm telling you this, I haven't checked yet, but they were wrong. I'm telling you they were wrong. This was a totally wrong reaction to the earnings. I don't know what these people are thinking when they look at these, when they trade something. See, we're coming back a bit, 38.61 now. And where was it? It was 35, yeah. So, wow, not a big deal. It's 38.61. It came back to where it was. But the thing is, that was an opportunity. You can't turn down an opportunity like that. But that's the whole point to what I'm saying. I raise my paddle. That's when I'll bid on, and I'll say, okay, 30 under $37, I'll take it. Okay, this is when I'll take it. I didn't want it when it was 38. I wanted it when it went down to 36. Suddenly it became interesting. It's a very small amount of difference, but it's the profit on my trade. You know, when you give up a buck here and there, you're giving up the entire profits of what you're gonna do on the trade. Here's little Crocs, and also, and I said stupidly cheap at 61. So let's see what happened to that. $75. Well, that's a big improvement. All right. Oh, there was even 2 charts. See, one's a dynamic chart and one's not. AT and no, there's no final T. All right, now AT&T again. This is a stock you own forever, and they're still doing like crap. Look at them. All right, so this is incorrect, but that doesn't, you know, this is what you're looking for. If you're looking for stocks to buy, this is what you're looking for. Like what did he pick that was a top trade that didn't do well? So here we were actually, we were only at 1850 when I wrote this, and now we're back at 18. But yeah, this is these are like ridiculous prices. I don't even understand how you can be down here. JP Morgan, and also MMB. So JP Morgan again, I think they had earnings, and I didn't understand why they went down. So I was like, let's just grab that while it's down there. We like Trox, we like Best Buy. Best Buy is only just recovering now. Trox is still dead. Levi's, good old Levi's. You guys hear me talking about them all the time. And see what I said? Cotton. Look at cotton pricing went way, way down. You're punishing them. This is 2022. So they're reporting cotton pricing here, but cotton pricing is now here. So next quarter, they're going to tell you how great everything was. But people they only go by what they see right in front of them. It's like, you know, a company says, oh, well, cotton prices killed its last quarter. Oh my God, sell the company. But do you even look to see what cotton prices are now? There's not many variable costs in the company. You know, they've got the same labor costs, the same equipment costs. You know, it's like Hanes, right? It's pretty freaking boring. They make jeans. They make a certain amount of jeans every year within a very small parameter, and the big variable they have is the cost of cotton. Hanes too, for that matter. You know, you can't just read the earnings report and say, oh, they did bad. Why did they do bad? Will they continue to do bad based on that? So here's Levi. It's a $7 billion company, $19.50. and they've actually been doing very well lately. They're moving up in brackets because they were forced to do a lot of cost cutting that was actually very beneficial. So when they were here, they cut a lot of costs. Now they're running much leaner and meaner. And again, the thing is, complacency. They were running this company the same way for so many years. And now that they were forced to cut costs, it's also good for companies sometimes when they're forced to cut costs. And now here we are doing $6 billion a year in business, substantially higher than it was. And they hit their, the add-on business is especially profitable. So they're running just barely 11, 12 times earnings right now. And what's one of their big variables? The cost of cotton. And it's a low debt company, so debt's not really an issue. It's only going to knock about 10 million bucks off earnings. So they're in fantastic shape. So there's no shortage of ideas, and that's the thing. Like when you're looking for a trade, we have the list. When I was on Money Talk, we made that list of all these different stocks I liked. I'm pretty sure we went over that last week. And we've got the top trade alerts, and then of course we always have the news to see what's going on. What stocks are interesting. I'll do that in chat mostly. I just don't want to go through all. Well, sure. I'll give you an idea what I do. Basically, I'm just going for the news. I have other sources. I have the Newsmax and stuff like that, but but then I just basically I'm looking for all right. So what am I doing? I'm looking at this. I'm like, DRLL, don't care about them. Marathon, don't care. Amherst, don't care. NGL, why are they losing money? 7%, not going to cry over it. Apple has bounced 30% from its thing. Oh, see, that's why the butterfly portfolio is doing so well. So we are going to have to cover Apple, I think. Yeah, look at that. We have 160 longs of the June 110s, and we're at 168 now. Oh, we're going to have to I think we're gonna have to roll these. I hate to tell you. God, they're so deep in the money. I don't want them anymore. Anyway, so we have 160 longs and we only have 80 shorts. We're only 50% covered, and that's why the butterfly portfolio is off the charts now, because it's insane. We just made a fortune on Apple. Because we were only half covered and Apple has had these huge gains. Because that happened. All right, but now we're getting to the point where we want to, well, in the butterfly portfolio, we're not supposed to be playing this aggressively. I think, what I think though? I think I'm going to sell half the, I think I'm going to take the money. That's smart. Let's do that. Then we can have $500,000 more dollars. Not that we need it, but we'll have $500,000 more cash, and we'll be less exposed to Apple. That's simple enough, right? The only thing is the 150s are so low. But well, all right. So if we sell half the apples, that's $550,000 of cash. So we take 550 cash. Doesn't matter. All right. That'll leave us though with 550, 123 minus 206, 200 minus these puts are inconsequential, but they're still there, but they're obviously so deep in the money that they don't matter anymore. So 12400 minus 7760. So 323. And we're going to have 80 of the 120, 150. So 80 times 30. Wait, yes, 320. Wow. Is that right? Am I crazy? It's 40. It's 80 times 40 is 320. So no, this is fully valued. So in other words, after cashing 550, we're left with 323. But really, the 110-80 spread is $320,000. It's 40. We have a time advantage here. Oh, it's a June 150 calls. Oh, that's good then. Then we can roll these. Wait a minute. Okay, so we can either cash it and get $320,000, or we can roll the 150. So the 2023 150s. I didn't realize they were 2023s. That is clever, Phil. I'm very glad I did that. Wow. Because the 2023s premium wears out very quickly, and therefore we're going to have the opportunity to make a nice roll. I am so happy. So these 150s are 22 bucks, 22.50, let's say. And if we roll them out to 2024, oh, look at this. We can roll into the 190s. We can add $40 of additional headroom. So in other words, we can cash the 80 extra longs that we have for $550,000. Then we're left with, and then we do this roll, and we're left with $80 spreads. Is that correct? 80 or yes, the one, yeah, left with $80 spread, $640,000. So we can still gain another $320,000 after taking $550 off the table. And now we gotta think though, do I really think Apple's going to be at its $3 trillion valuation by this time? But what we are going to do is we're going to take these other guys off the table and put $550 in the bank because there's no reason not to. So that's going to put us in fantastic shape, and we'll have, and again, Apple's one of the big reasons we hedge. So once we do this with Apple, we then have less need for hedging on the NASDAQ, and that means we can maybe take some money off the table on our hedges too. Because that's, we have $550,000 we no longer need to protect if we cash in that piece. I am liking this plan. Because that's why we have such obscene profits in the butterfly portfolio. Brendan says, I can't log into the site to post a comment and question. I know this is not a platform for it. Yeah, well, I sent several emails to the admin address. Please have somebody reach out. I will, Brendan. You got to remind me. Just send a note to me to Phil at PhilStockWorld. Maybe you did, but I just honestly we've been so crazy with this platform stuff. But there was an issue with the billing that we're fixing now, and we're getting everybody's account straightened out, and I will get it taken care of. But I'm going to forget by the time we get done with this webinar, and this thing doesn't save these comments. So just drop a note to Phil at PhilStockWorld and Andy at PhilStockWorld as well, and we will. And now we certainly, after this weekend, we now have a handle on things, and we'll be catching up on all that stuff. Okay, thanks. So yeah, I don't know why you can't get in. All right, charts. All right, everything seems to be holding up all right. What else? Gasoline is back over 3. That's a shame. Oil is, where's oil? Oil's back at 92 again. Aw, that's not good. Natural gas popped right back up. Look at that son of a bitch thing. That's one day. That's why we can't play. That's why we're not playing it, because you can't really play it when it's going to do shit like that, because I mean it would be a great move if you happen to call it, but if you get it wrong, it's going to rip your account to shreds, and that's no fun. So where was I? Yeah, so that's crazy. Oh, Amazon too. Oh, I wasn't as aggressive on Amazon. Actually, look what happened to us, because we have September calls. We see we're getting burned on that. So those have to be rolled, and they will be rolled. But you see what I mean, really, this was the logic of that. We got burned. We were worried about Amazon into earnings. And what happened is they did pop. June. Okay, yeah. So we were worried about these into earnings, but they did well. And the thing is, though, because these have the shorter expiration, even though they're much lower in the money, right? We can just roll them. They're 33 and these are 30. So we can roll the 110s to the 145s, and we'll still only be 100 out of 120 covered with a $20 spread, which is $250,000. And how much is this? $240,000. So it's 494, 494, 400 minus 184,050 minus 133, 600. It's only 176, so there's going to be 50,000 left to gain. But the thing is, I gotta decide if we want to do that. Is that going to be worth it to make $50,000 more dollars and waiting 2 more years basically to make 50,000 bucks? I'm not sure if that's worthwhile. We can do better. It's only making 30% in 2 years. So do we want to tie up the money in that? And I'm not even a big Amazon fan. Just was a trade at the time. So it's profitable, but not hugely profitable. What is it? 224 minus 312. I don't know. It's not 100,000, like 90,000, 80 something $1,000. Which is fine. We only took the trade in 518. So again, a trade doesn't have to. You don't have to stick mindlessly to a trade. We made $80,000. There's only I forgot. There's only $50,000 left to make. It's no longer really worth the trade. We can find something better to make money on. That's what and I would love to cut back on stuff. I'd love to have more cash. So I think that's a good one. If we do that, then the butterfly portfolio goes back to normal. We accidentally got into these huge positions just because, because the opportunities present themselves, basically. We didn't start out with a gigantic Apple trade, but what happened is when the stock went up and got to 150, we took some profit because we felt that was a little bit high. Went down to 137, we jumped right back in and doubled down on it. Then it goes up to 180, and we said, screw that, that's crazy. When it hit 3 trillion, we sold Apple. I don't remember the exact number, but when it hit 3 trillion, I was like, that's it, bye. And then it came back, held the 50-day moving average. We got back in, it jumped back to 3 trillion again. And I said, again, let's get out. Then we had this fantastic thing happen to us. We bought back the short calls, doubled down on the longs, and then it recovered. And presto changeo, we make $500,000. But all we're doing is playing a channel. We buy it when it's down around here. We sell it when it's up around here. It's not complicated because we know what Apple is worth, and it's not worth this much. It's not worth 3 trillion, but it's certainly worth more than 2 trillion. So it's not a hard thing to decide. And that's what leads to these gains. But now, I'm glad I looked at this today, actually. So now this can be cut in half, and this can be cut completely, and we go back to a fairly normal butterfly portfolio, which is going to make me really happy. And you do want to get back to like a normal portfolio when it's up 800%. It's like, okay, that's enough. I think we really accomplished our goal here. That's crazy. That is a crazy amount of money to make. And generally in the butterfly portfolio, any trade is good for. Oh, here's Disney. Oh, when's their earnings? Did they have it, or is it today? Disney. Must be tonight. Tonight. Wow. See, I don't feel it's that risky. Based on what I've heard from the cruise lines, based on just being in Orlando and I was just at Disney a couple of weeks ago. It couldn't be more packed. You can't get a table at the restaurants. Every restaurant at Disney we went to was packed, and literally we had to get, generally, because I'm not a big advanced planner, we had to make some funny reservation times because we couldn't get the prime time reservations in a lot of places. The parks were packed. The vending stands were active. It wasn't like people weren't spending money. Everybody's walking around with bags. They're buying the merchandise, even though the merchandise has gotten really expensive. The hotels were full. Also, so what's left? Disney Plus seems to be doing very well on the streaming side. ABC, the sports are coming back. That's got to be good for ESPN and ABC. I just don't see where the downside's really going to be hitting them right now. Obviously, Shanghai closed. That's a problem. But I don't think. I mean, it's obviously going to be better than last year. It was closed last year too. So I don't see enough downside to justify them being this low. And then we look at Disney. I'm sorry, it's a visual. I'm not a chart person, but I mean, it's a visual when you kind of want to get an idea of where it was and where it is. So last year, now this is $200 billion, not nothing, but it's $200 billion. So let's look at where they were. 2016, let's go back 5 years. Okay, so when they were trading down here at this price, well, let's do all if we can get to. It's 2016. Yeah, this was their normal price. $100 was the general price for Disney. Okay, so when they were trading at $100, they had 9 billion, 8 billion in profits, 55 billion sales. Okay, now their sales are up very, very significantly up. The profits aren't there yet, but all the issues they've been having. The cruise lines are bleeding cash. The less occupied cruise lines, they're just working their way out of that. And of course all the other stuff in the movie attendance and so on and so forth wasn't back 100%. So they've got this ahead of them that they're going to get back to 12 and 11 billion dollars and whatever. So let's say 12 billion dollars. And that was with obviously much less revenues coming in. So if you look at them and say 12 and we're at 196, then they're running at 15 times earnings. So I think longer haul, I absolutely want to be into this thing. They got scary amounts of debt though. 38, that's a big amount we got to knock off here. It's about $1 billion. So 38, 7 times 0.03, $1.1 billion of this number here I would take off. So I would say they're going to continue at about 8. So if you want to realistically where they're going to be at 196 divided by 8. 196 divided by 8 is 24.5. So I would say that they're going to be closer to 25 times earnings going forward once they start having to pay the higher rates on things. Now, of course, Disney is Disney. They're going to be able to borrow whatever the lowest possible price is. They're going to be able to borrow at that price, but it's not magic. They will have to pay interest. So I don't think they're going to blow up and go hugely high, but I think this will be the time we cap. So that's basically, so I think earnings will be not worse than expected because expectations are kind of low. And I think that they'll have a good turnaround story. And if the stock pops though, we're going to definitely cover. Because that's when we don't need to take a huge risk on. We're taking a huge risk now because if earnings are bad, then we're going to lose that money. Ford is Ford, no worries there. IMAX, we expect that to come back better. Coca-Cola is Coca-Cola. This is a very boring portfolio, right? Like, oh, Coca-Cola, what do you what do I have to explain why we like Coca-Cola? That's the marijuana ETF. We're waiting for them to pass the law to make it federally bankable. Unilever, we left that aggressive. Walgreens again. And Whirlpool, good old Whirlpool. So I don't know. I mean, it's a simple portfolio basically. Once we cut these guys out, then it's just then it's like just go to sleep and forget about it. Dividend portfolio, dividend stocks are doing pretty good, I think. Yeah, that's up a bit. And the futures now have crazy numbers. I mean, it's just it was. See, now it's at 20% more. It was -%, like -4 or 5% last time we reviewed it. I just looked at it the other day. It was 80. Now it's 100. I mean, because these are exactly the kind of stocks that do recover, right? Everybody lost faith in all these things, and now now everybody's excited. I just reviewed this the other day, so I'm not going to go over it again. It's in Tuesday's post or something like that. I reviewed it, or when was Tuesday? Tuesday was yesterday. I would guess Monday then. I do remember doing it this week. But these are forward-looking stocks. So you have to be enthusiastic about the market to believe in them. But so far, this is a nice comeback, and all we wanted to do this week was hold 4160. So now we got a nice cushion there as well. So if we can close the week above 4160, which is back to saying this support line over here, the weak bounce line, then we're where? We're in the top of our expected range. And as long as we can stay on the top of the expected range, we're going to be pulling the 50-day moving average up, and the 200-day moving average will not be held down too much. So hopefully we work our way back to around here before the 200-day falls below the 4320. Or it's kind of well, it is 200 days, so it's not going to have very much movement. In fact, again, all this is calculable. This is not unknowable. And I hate TA people because they drive me nuts. They don't take the time. They pontificate about all these patterns and things like that. And meanwhile, I'm like, it's very simple. It's like this candle here is at 4205. The baseline is 4332 is the 200-day moving average, right? So then minus 4205, which is where we are, is 127 points. And if we divide that by 200 days, that's how much per day we are dragging the 200-day moving average down. And since we're looking at $4,300, right? 4,300. We're looking at 4,300. Well, I'm sorry, the support line is 4,320. So we have 12 points, right? So now we take 12 divided by 0.635, and we have 18 days. So we have 1 month of trading, right? 18 trading days, 19 trading days. So we have 1 month to get to 4320, or we're going to pull the 200-day moving average below 4320. But every day we're higher than this slows it down, right? The number becomes smaller every day that we're above this number. And so if it goes here, it'd be half as long. So as long as we are making progress in this direction, we have at least a month to get to 4320. But the problem is, technical standpoint, we are exhausting this MACD. See, this is strong upward trend here on the MACD line, which we talked about when it was here. A month ago, we were talking about how we were going to have a very good time because the MACD was in a positive thing. And again, I swear how much it drives me nuts that I'm not a TA person. I only incorporate the TA because I know how TA people react to things, and that signal is a strong signal that will cause a lot of people to say, oh, we should be buying now, blah, blah, blah. It's a signal. But in my fundamentals, I take TA into account because so many people follow it. But honestly, it's just nonsense. It only tells you what did happen. It doesn't tell you what's going to happen. But I'm telling you what's going to happen. I'm telling you that we're in this zone. Now, here's the problem, though. We have a month. But in the course of a month, this is going to happen. This line here is going to hit this line. And we're going to exhaust the trend. And then we're going to hit a downtrend. So it'll suck if we hit this line and get rejected. And that's most likely what's going to happen. So without a catalyst coming in the next 30 days, then we're going to know ourselves that when we get up to this line, we should be starting to go back to our hedges. Because first of all, we think that's the top of our range anyway, valuation wise. We think there, and again, valuation wise, given the war, given inflation, given the economy, so on and so forth, given the factors that we know, that's where we think the proper top of the range is. So what should we be doing now? We should be doing what I was just talking about. We should be cashing out these big positions that are very profitable and moving to a more conservative play, and then seeing what happens over the next 30 days. Now, if we break up, then we go back to buying things. But if we don't break up, then we're going to be freaking glad we cashed in the 800,000 we're planning on cashing in the butterfly portfolio, right? Then it'll be nice to have another $1 million to play with so that we can buy some more things. It's that money's in the portfolio now, but it's tied up in positions. And why on earth would I keep it tied up in positions when again, like I said, it's not enough upside for me to tie up the money in those positions. I love Apple, but they had their run. It's fine. I don't need to be in it right now. All right. If Apple, which is what, 170 or something now. So if Apple's at 170 now and I miss it and it goes up to 200 and it breaks over 200, then I'll take a 200, 250 spread. I'll say, oh God, I was wrong. So let's play it for the 200, 250. And I'll take a cheaper spread that instead of having $1 million tied up in it, we'll have 100,000, 200,000 tied up in it. And if it goes well, we're going to make another $500,000 anyway. The same $500,000 that would max out the position we have now. We're not going to miss much except for the gap that we leave. Okay, we're going to leave a gap of when it starts breaking up on us, but then we can get right back on the horse. It's not like we miss it. It's not like we can't get there. It's not see, people say a lot, the train is leaving the station. It's not a train that's leaving the station. You can still get on it anytime you want. It's not going away. And in fact, my brother, I had told him to get out of Apple when it was 180, and now it's back to 170. He goes, see, I didn't get out of Apple, now it's back to 170. I'm like, yeah, but it was like 120. You could have gotten out and gotten back in and had 50% more Apple than you have now. And then you'd be thrilled it's at 170. Now you're freaking back to where you were. You don't just, you don't get paid to be faithful, unfortunately. You don't get rewarded for faithfulness in stocks. It doesn't work that way. So, when you have an opportunity to take a good profit, take a good profit, okay? If you never get, it's possible the stock takes off and goes crazy and you never want to buy it again, like ISRG. That's a good example. There's one we used to play. I loved it, and I still love it, but it's too freaking expensive. Well, not as expensive, but it got crazy when we got out of it, and it went crazy. They split, so I forget what it was in the thousands. But it went crazy, and it got way too expensive, and I lost all interest in it. And had I seen this, I would have bought it. Frankly, I didn't even realize that when it happened. But it's a great stock. I still love it for the long term. I think it's a huge futuristic thing, but it's just not cheap. So we never got back into it again. So you can miss it. You can get out and miss something. But, we took our money and put it elsewhere into things that were a little bit more productive, and that's how it works. All right. Anybody got any questions? Let's see. Naomi would like me to look at TTD. She has shares and is thinking about selling some calls. Trade TTD. Well, they just popped 34%. So yeah, I would do something. I don't follow them, so I don't want to give half-assed advice on it or anything. Let's take a look at their basic numbers. Wow. So now they're at $26 billion, even though they only make $500 million a year. Now, it's growing fast. Everything looks fantastic. Look, the revenues are freaking double. I mean, up 50% from last year. Next year, up another 33%. That's great, but they are trading at like 50 times earnings. So 26, yeah, 50 times earnings. They're probably debt-free. Yeah, they're not debt-free. They have $1 billion in cash. All right. Great company, great positioning, right? Everything seems good. So the question is, you have the stock, don't know what you have the stock for. I would frankly, they're never going to pay you a dividend. There's no point in owning this thing. So I would cash the whole thing. I would cash it out and buy a spread. Let's say you have 1,000 shares at 70, say you have $73,000. If you take that money and now what you do is you sell It's at 73, right? So you sell the $50 puts for like 10 bucks. So let's say you sell 5 of those, right? All you're doing is promising to buy 500 shares at 50 bucks. And for that, they're going to give you 10 bucks. So your net is 40. All right. So you collect $5,000 selling the $50 puts. It's obviously less margin than you're using now, because all you're doing is obligating yourself to buy 500 shares at 40 and net 40. You're going to get the $5,000 in your pocket right away. Then upside wise, so if you take the now, as far as positioning, if I take the 75 to the 23, what if I go $10 lower? The 65s are 28, so it's $5 more for the 65s. The next ones are 32. The 55s are 32. That's only $4 more than those. And the 45s are 38. So let's stick with it. So the 55s are the best deal, basically. And again, I'm not going over every single strike, but the 65s are a very fair deal. The 60s are 30. That's $3 less. Those are an even better deal. All right. So the 60s for 30, excellent deal. And let's say we're willing to put 10 bucks into this thing. So we can go to the 60s and the 90s. Okay, so the 90s are 1850. Maybe a little bit less. Let's say 1820. All right. So what do we say we're going to buy? The 50s? Did I say? No, that doesn't sound right. 32. Wait, I said 60s. Oh yeah, sorry, the 60s. So the 60s are 30 bucks minus the 90s are 1820. So it's 1180. So the 60-90 spread is 1180. So you have 1,000 shares now. So you buy 10 of those, right? And that's so times 1,000 is $11,800 minus 5,000 you're selling on the puts is $6,800. So you're taking $73,000 off the table if you have 1,000 shares, and you're replacing it with 10 spreads at 60. They're in the money. So they're $10,000 in the money for $6,800, and you're obligating yourself to come back in at 50 if it falls below 50. So your net re-entry would be 50 plus the 68 you're losing is 5680. So your worst case would be coming back for 5680 on 500 shares, on half as many shares as you have now. You've got 6,800 in play, and you've taken $73,000 off the table. And at least, even if you have an IRA, you're still knocking half of your margin requirements off also. So, and of course, you have the upside potential on that would be that you would make $30,000 back, $23,200 profit if it hits 90. Whereas if your stock hit 90 now, you would only be up $20,000. Okay, now you can make more at 100. You could buy 20 instead of 10 and have double the upside. There's all kinds of things you can do. But I would do that. Something in that nature is what I would do with it, rather than stick with the stock, keep your $75,000 tied up, and then just collect, let's say $15,000, $20,000, capping it anyway. What's the point of that, right? That doesn't make any sense. This is a much smarter play, is to flip to an actual stock spread. And again, wouldn't be my first choice to have this company in the first place, but you did well. It was a good pick. It popped up on you. You want to lock it in. That all makes sense. But I'm saying take it off the table. Put the $75,000 into something else. You only have to leave a little bit in there and have another 30,000 of upside, so you won't have any regrets, unless the stock goes to 150 or something like that. But and who knows? It might. It's a small company. It can move quickly. I just think that probably. I don't know. I mean, it's just me. I'm not a big jump on the, I'm not a big jump on the bandwagon person for stocks like this. But there's nothing wrong with Trade Desk, and and they could easily get up past 90, but I think 90 is a very fair price. So that's what I would shoot for more conservatively. And again, you put in the other money back to work, it's going to make money too. That's another thing people don't realize is they, when you look at a play like that and you think about taking the money off the table, just like, the butterfly portfolio. I don't know what we're going to do with $550,000 or $800,000 we're going to take off the table. I just know I like to have it. When I have $800,000, I find something to do with it. If I don't have $800,000, even if I find something I want to do, I can't do it. So I'd rather have the money and look for things to do. All right, voice is going, so let's see, any more questions? Oh, review the hedges and have a plan, says Bernie. All right. Short-term portfolio. Well, we have a plan. Didn't I just say that? I mean, here's what's going to happen. We're going to, the hedges are extremely well covered. We have 100% upside on these things. Now, not 100%, but the ability. I mean, none of these are in any way hampering us from moving forward. So we probably have too much hedging, given where we are, given the improvements we see in the charts. I think my primary goal is going to be taking a couple of these 30s off the table. It's not going to make much difference, though, honestly. I mean, the hedges being what they are. The 70 calls. See what's weird here? The 70/80s are like the same price. Isn't that crazy? Look at that. It's like 1038 and 975. There's a 60-cent difference between these two hedges, between the two short calls. So, I mean, I could roll those up. We have these 300 of these. The 60s are 11. Also, not much difference. Not even $1 more for the 60s than the 70s. So there's only a couple of bucks separating these guys. The big money is in these, but these were 35 bucks when the market was down. I think if we start cashing these out, first of all, I think we could do better on a dip, and second of all, I just think it's needlessly, it doesn't help. There's no real change in position there. TZA, there's no money in the longs, is there? I mean, we have 400 of these and 300 of these. The 202 425s, and again, they should be a lot more money. We bought them for 17. So when there's a dip, I will sell them, but not now. I think we're fine. I think these hedges are fine. And what we're going to do is it's not a change in the hedges. What we're going to do is start cashing out some of the longs, and then we have less that we need to hedge. That will then cause us to be too bearish, and we'll look to see what we can do. Maybe see TQQ is with TQQ. We're waiting for the premium on these puts to expire, and then we'll roll them eventually anyway because there's a year advantage here. We have these long XQQs too, the 50s. I forgot about those. This Coinbase, I think maybe we'll be done with that. The DIA spread, I don't know. Maybe we'll catch that out. There's really not much to adjust. It's really incumbent upon us to buy more longs to cover that we have these hedges. But we're not going to. You don't cash out at the top of your range and say, now I'm going to buy back my hedges. That makes no sense. This is when they're cheap. Right now they're very cheap, and they will cover us tremendously for any kind of downturn. So what we should be doing is looking for longs to buy. So what we're going to do is when we do hit this goal up here, we're going to then get more aggressive as far as like hedging ourselves to the downside, hoping we catch a down wave that we'll be able to cash in on. Then I'm going to want, like if we come back down to here in the 50-day moving average, then I'm going to want to get, take some of those cues off the table. At the moment though, no, the thing we want to do has nothing to do with the short-term portfolio. It has to do with looking at our other portfolios and saying, now that we've made all this money, let's cash out some of these long positions that we can find. So that's what it is. It's not going to be a short-term adjustment. You can't, not, it doesn't work like that. It's like we want to remove the need to hedge first. So in other words, here's where we added a lot of hedges. Here's where we cashed out a lot of hedges. Here's where we got bullish, in fact, on our hedges, and now we're up here. But at this point, like I said, the cash that we made recently is our hedge, the 4.3 million, the 300,000 above our target goal of 4 million in the long-term, short-term portfolio. That's our hedge right now. That's our cash hedge. I don't want to get more aggressive on the short calls, on the short positions in the short-term portfolio, because I think that we're in good shape. I don't think we're going to go down that quickly. If we do, we're well covered just in case. But what I'm more worried about, though, is I just made all this freaking money in Apple and I made all this money in Amazon, and I want to take that off the table. Not the hedge. The hedge is fine. It's the profits that we want to protect. And you don't protect the profits by just leaving them on the table. You protect the profit by going to cash and waiting for the next great thing to come along. So that's where we are, all right? That's our plan. Next week, we're going to review the portfolios, I think, right? Yes, next week is portfolio review time, and that's going to be exhausting. So I'll see you guys then. Thanks for coming, everybody.